Okay, good morning, everybody. It's Wednesday. It's 10 a.m. It's time for a Wednesday weekly webinar. Happy Wednesday. Happy October. It's October 2nd. Last week we had our guest, Thomas Byelich from Cornerstone, our partner for our investments and our investment consultants. And if you didn't watch it, go back and watch that webinar, or listen to it on the podcast or on YouTube. I think you'll get a lot out of it. We talked about investments in the markets. Thomas did a nice piece about common market returns after a presidential election. So I know that's on top of everyone's mind right now, is the upcoming presidential election. I think it was good information. So Thomas, if you're listening, I appreciate it. And let's get into this week's webinar. So we're going to follow our normal format. I've got some slot updates. Boy, I've said this now the last few times that we've included the slot updates. There's just so much coming out of the Secure 2.0 final regulations that sometimes it makes it challenging to weed through what's best to share, I think. But we're going to go through some slot updates. We're going to talk about the markets a bit, and then we're going to get into our financial focus. And our financial focus today is Roth conversion, break even, and opportunity costs. So this is good morning, Don. Thank you for saying good morning. This is a question I get all the time. So whether it's during a class or just when I meet somebody and they're talking about Roth conversions, they say, what is that break-even point? So, and what about the opportunity cost of the funds you're paying to tax for that Roth conversion? So these are really good questions, and the answer is pretty simple, but you're going to see it. We did talk about this a couple years ago. Good morning, Marty. Good to see you. We talked about this a couple years ago, but I think it's time for a refresher. And like I said, it is a common question, and we're going to go through it. So I just want to remind you of the goals I have for you. I want you to be inspired to make changes. From the goals for this, listening to these webinars today and on a regular basis, or listening to the podcast. I want you to be inspired to make changes. You know, we've been programmed for so many years. I was that way until I met Ed Slott, and really came under his instruction and tutelage in 2012. I was taught a certain way by the big firms, and honestly, it's just not the best way for many people. So I want you to be inspired to make changes. I want you to open your mind to different ideas and different ways of thinking about planning and investing. I want you to stay educated so you feel confident in the plan and strategies that are put into place. And I want you to stay updated. Listen to these webinars. What I find is people that listen on a regular basis, I've seen, are more successful in staying with their plan. So stay updated so you make adjustments along the way. It's very, very important. Obviously, share this information with your friends. These webinars are about education. The podcast webinar, it's about education. It's not about individual advice. Individual advice should be one-on-one, not broadcast out to the millions of people in YouTube universe. So they're my goals for you. Now let's jump into some upcoming things that we have. I told you when we changed the format from Tuesday to Wednesday, I had some things I wanted to do. And one of them is I wanted to bring in some guest speakers or a guest to this webinar on a regular basis. And we've done that. We've had David McKnight on twice already this year. We had Thomas Byelich join us just last week. And we have Heather Schreiber joining us on November 6th. So I'm excited to have Heather back with us again. If you don't know who Heather is, go to our website, attleborowealth.com. That's over here, attleborowealth.com. And you can see Heather's bio. So Heather is certainly one of the top 3 Social Security analysts in the nation. We're proud to have her on our team as well. So Heather reviews every Social Security situation for our client. And we're excited to have her back on a webinar on November 6th. So pencil that in. Make sure you pay attention. And we've got some other guests that I'm working on. All right, so let's get into the slot report. I'm going to share my screen with you. So this is I'm just going to tell you, if you're listening on the podcast or listening on the YouTube only, then make it a point to come back and read along with us, because what I'm about to read to you is a bit could be a bit confusing and certainly complex. So we're going to talk about different dates and different actions, and let's just go through it. So the title is Surprising News About the New Statute of Limitations for Missed RMDs and Excess IRA Contributions. And it's from our friend Ian Berger. I'll see these folks in just a few weeks out in San Diego. I'm looking forward to seeing them because I missed it in the spring. But Ian writes, a big change made by the Secure 2.0 Act of 2022 was adding a new statute of limitations for the IRS to assess penalties for missed required minimum distributions, or RMDs. So we have an SOL for RMDs and excess IRA contributions. On its face, it looks like the new SOL, statute of limitation, is 3 years from the missed RMD penalty and 6 years for the excess contribution penalty, but looks can be deceiving. So Ian writes, but looks can be deceiving. In fact, for most of you, the new look-back period will be 6 years for both penalties. The penalty for a missed RMD used to be 50% of the amount not taken. It used to be the largest penalty in the books. Actually, I think it still is. Secure 2.0 reduced this penalty to 25% and down to 10% if the missed RMD is timely corrected. This change was effective beginning 2023, but the IRS can excuse this penalty if you ask for a waiver. To do so, you must take the missed RMD and file Form 5329 with the IRS explaining that the RMD shortfall was due to a reasonable error. An excess IRA contribution is a contribution that exceeds the amount you can contribute to your IRA or Roth IRA in a year. For example, making a Roth contribution when your income is too high or rolling over an RMD. The penalty for an excess contribution is 6% for each year the excess amount stays in your account as of December 31st. There is no penalty if you correct the excess contribution by October 15th of the year after the year for which you made it. The IRS cannot waive this penalty, unlike the penalty for a missed RMD. That's important. Cannot waive that penalty, unlike the penalty for a missed RMD. Before 2022, most people had no statute of limitation protection. They were SOL in another way, but there was no statute of limitation protection, and the IRS could go back indefinitely to assess both penalties. In Secure 2.0, Congress tried to remedy this by providing new look-back periods for both penalties. And this is the kind of stuff that we review and learn at the Slott Group updates that, again, I'll be attending in a few weeks in San Diego. But I love reading these court cases and these court decisions. But as an example, in a recent tax court decision, Courtier versus Commissioner, and the following numbers, the court ruled that the new 6-year SOL for the excess IRA contribution penalty is not retroactive. Although the court didn't address retroactivity of the 3-year missed RMD penalty SOL, again, statute of limitation, the decision also almost certainly applies to that penalty as well. So they're carrying over the RMD statute of limitation along with this court decision. This means that there will continue to be no statute of limitation protection for either penalty for years before 2022. That's when the Secure Act came out. For 2022 and subsequent years, the look-back period for the missed RMD penalty for most of you is actually 6 years, not 3 years. The only way to keep a 3-year look-back period for any year is to file Form 5329 with the IRS each year, indicating that no penalty is owed for that year, and attach enough information to the form to show the IRS why you believe there is no missed RMD for that year. This is sometimes called zero filing. But very few people will go to all the trouble to do this. Anyone who doesn't will wind up with a 6-year look back if the IRS hits them with a missed RMD penalty. For 2022 and future years, the look-back period for the excess IRA contribution penalty starts at 6 years. The only way to get that down to 3 years is to use the zero filing strategy and provide the backup documentation showing why there is no excess contribution for that year. Once again, this is not something many people are willing to do. So the bottom line, whether you miss an RMD or make an excess IRA contribution, if you don't fix it, the IRS will have 6 years to come after you. So at least there is that statute of limitations now, and it appears to be 6 years in total for both instances. But you can see, again, this is another example where this is just so darn confusing, and why you've really got to have your team in place to help. A lot of these RMD issues I see are with people. We manage clients' RMDs quite well, frankly, to make sure that they don't miss their individual RMDs coming out of their IRAs. But what we see is people who inherit IRAs and maybe don't take those distributions for sometimes years, and then that has to be corrected. So a lot of these RMD issues come from inherited IRAs. That's why it's important to make sure that if you have an inherited IRA, you understand your responsibilities and the rules. And if it looks like you're going to be leaving IRA money to your heirs, make sure they understand it, or make sure they're working with someone who understands it. And one of the best ways to avoid the problem at all is to eliminate the RMD. And the only way you can really eliminate an RMD is to convert to a Roth IRA. So that may be something you want to do for yourself and your heirs, and it's worth looking at. It's not for everybody, but you want to consult a qualified individual to see if it works for you. Eligible designated beneficiaries and disclaimers. Today's Slott Report mailbags. These are questions that are written in, and the team answers them. So this is from Sarah Brenner. The question is, when an IRA owner dies after the required beginning date, can an eligible designated beneficiary choose either the life expectancy option or the 10-year payout rule? Again, another confusing area. I had a conversation with a CPA. It's been about 9 months ago now, but they were arguing this 10-year payout rule, kind of just putting everybody in the category of, well, if you inherit an IRA, you have to now, under the new rules, you have to deplete the entire thing by the end of the 10th year. That is not the case with everyone. And in this letter, this answer, Sarah's talking about eligible designated beneficiaries, and I'll remind you what is an eligible designated beneficiary, or an EDB, at the end of this, or who is an eligible designated beneficiary. When an IRA owner dies after the required beginning date, can an eligible designated beneficiary choose either the life expectancy option or the 10-year payout rule? The answer is, if an IRA owner dies on or after the required beginning date, the 10-year rule is not an option for an eligible designated beneficiary. The 10-year rule for an eligible designated beneficiary is only available when the IRA owner dies before the required beginning date. After the required beginning date, the eligible designated beneficiary would have to take distributions over their life expectancy. So again, these RMD rules are just more and more confusing as the tax code is touched and the regulations are touched. Question: can an IRA beneficiary do a partial disclaimer, or is a full disclaimer required? And the answer is, a beneficiary can disclaim all or part of an IRA that they inherit. A full disclaimer of all the inherited IRA assets is not required. So what's a disclaimer? A disclaimer is, I've been named beneficiary of whatever it is, in this case an IRA. You can say, I don't want it. You fill out a form and you submit it to through the proper channel, the custodian, and you've disclaimed that property. It can be, as Sarah said, all or none, a portion of it, however. Well, I guess you wouldn't do anything if it's none, you'll just receive it. But it can be all, you can disclaim all of it or a portion of it. And then then you have no control who it goes to, though, right? It goes to the next person in line if there's a contingent beneficiary, or it'll just follow whatever the rules are by your state and the custodian. The custodian has some rules in their agreement that govern that as well. So that is disclaiming. So let's talk. We talked a lot about eligible designated beneficiaries up here in this question and answer. And let's list who are the eligible designated beneficiaries. Remember, there are four classes of eligible designated beneficiaries. They include surviving spouses, minor children of the account owner, disabled individuals. So that follows the rules of disability by the Social Security Administration, the chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. Fairly simple, but different rules for those folks. We're going to talk a bit about the markets. So let's first just do a snapshot of what happened last week in the markets. If you didn't see the webinar last week with Thomas Byelich, where we talked about the markets and investments, like I said before, you should go back and look at that. I do deliver those to your inbox, the recordings of the videos to your inbox. So if you're not receiving emails from us, you can go to questions@outobarwealth.com. That's questions@attleboroughwealth.com, and let us know, and we'll get you signed up. You can also go to our website. That's attleboroughwealth.com, and click into it. I'll admit that it still says Tuesday weekly webinar. We're redoing our website again, but you go into where it says webinars or weekly webinars, and you can click in and sign up yourself. But if you don't want to do that, you can just reach out to us at questions@attleboroughwealth.com, and we'll get you signed up so you receive the emails. And of course, go to the YouTube channel and hit the subscribe and notification button and like button if you like the videos, because you're ahead of the game. The videos are generally posted on YouTube on Friday, and they're delivered typically to you on Monday, so in email, so you'll get them a little sooner if you subscribe to the YouTube channel and are notified of the videos. Good morning, Denise. Thank you, everybody, for checking in. So what happened in the markets last week? So the Dow Jones Industrial Average was up slightly, 0.59%, still 12.27% for the year. The S&P 500 was up 0.62%, still up 20.30%. The NASDAQ was up 0.95%, still up, what does that say, 20.71%. Mid-cap stocks were up about half a percent to 12.14. The Russell 2000, which is small companies, fell a little bit, 0.14, still up 9.75% for the year. And even global markets. The only thing that's showing red, other than the Russell 2000 on my screen, is bonds. So bonds were down ever so slightly, 0.01% for the Bloomberg U.S. Aggregate Index. As I always say, that's where most people invest their bond money. That's a 7 to 9 year maturity window. But that index is up 4.69% for the year, and that most of that upward movement has been in the last 30 to 60 days, I'd say. So that's a snapshot of what happened in the markets last week. Now let's talk about what our analysts had to say about last week and what's coming up this week. So last week we had jobless claims. The number of U.S. workers that initially filed for unemployment fell to a 4-month low of 218,000, while the less volatile 4-week moving average fell to 224,750, both better than estimates. The claims reading is considered the forward-looking indicator for the labor market and continues to indicate strength. Should claims readings continue to run in the current range, the analyst writes, future Fed rate cuts could be more muted than the 0.5% initial cut. So they're saying that it could certainly lead to additional cuts, but smaller, 0.25%, for example, instead of the 0.5% that we saw a week or two ago. We also saw the PCE index. The Fed-favored inflation gauge rose 0.1% month over month and 2.2% year over year, both below expectations, while core PCE, which excludes food and energy, rose 0.1% month over month and 2.7% year over year, a tick higher than the previous month. So the analyst says, as has been the case with other recent economic data, the PCE report provides arguments for both the hawkish and the dovish sides. Headline inflation dropped and is now close to the Fed's 2% target, but the core level rose and remains elevated. The divergence argues for continued Fed cuts, in our view, the analyst view, but at a gradual pace. And that seems to be what everyone's thinking right now, is that the cuts will continue, but not as aggressive as we saw in the last one. What we have up ahead this week, one we already saw yesterday was the ISM manufacturing. So this is the measure of sentiment in the manufacturing sector, and it's shown weakness and will be looked at for signs of further slowing. So here's what we saw. There was, in fact, weakness. So that came in yesterday, and this is an excerpt right from the ISM report. New orders index remained in contraction territory, registering 46.1%. So we're still seeing reductions in that index. Thursday is ISM services. Sentiment for the service sector has been stronger than manufacturing and is viewed as more important to U.S. economic growth. And Friday with the labor report. This is the big one. So for the week, the labor report. This report has become the highlight economic report for the month for investors and will be looked at to signal as to what the Fed's next move may be. So let's all gather on Friday and look at the labor report together. Just kidding. We'll look at it separately. All right, that is that section. So I'm just going to do some adjustments here. Okay, so this is the financial focus portion of our webinar. And today's financial focus is Roth conversion, break even, and opportunity costs. So this is a question I get, or these are questions I get all the time, whether it's coming out of class or just talking to individuals as they reach out to us, schedule time with us, what have you. And if you want to schedule time with us, there's a link in the description of this video, or you can reach out to us at questions@attleborowealth.com, questions@attleborowealth.com, and that's for a 15-minute discovery call. But these questions are, we talk a lot about the tool that we have and the power of this Roth conversion strategy, but often people say, well, what's my break-even point? If I convert $100,000, how long does it take for me to make up that money that I pay tax, the difference? And sometimes it's not how much time, it's how much growth. What about that growth? What about that opportunity cost? I send money to the IRS. Now that money's gone. It doesn't get a chance to grow. So does it really make sense to do this thing called a Roth conversion if I'm sending my money away and it never has an opportunity to grow for me? And what is that? How much do I need to earn for that to break even? They're really good questions, and we're going to explore them. And I think it's going to be eye-opening for you. It may be eye-opening for you. So first, let's talk about Roth conversions basics. So what is a Roth conversion? So very simply, I'm not going to get into too many details. We're just going to look at it simply. And I've got our buckets here, your taxable bucket, your tax deferred bucket, and your tax advantage bucket. And if you've followed this video at all, and if I guess I should say, if you haven't already, hit the subscribe, like, and notification buttons so that you're always notified about these videos. But we know that your taxable bucket holds everything that is not a retirement account. Let's just keep it simple, right? So your individual mutual funds, your individual stocks, your individual bonds, and you get 1099s for that come out of this bucket. And the 1099s are for interest, dividends, capital gains, whether they be short-term or long-term gains. Sometimes you get K1 reports out of here, but all these equal tax. So these are forever taxed. So my mentor and friend Ed Slott would say that these buckets here, your taxable and your tax deferred buckets, are forever tax buckets. So then you've got your tax deferred bucket. So your tax deferred bucket is anything you've promised to pay later, right? So we've got your IRAs, your 401ks, 403bs, all traditional. They got the tag traditional in front of them. So you put money in, you either get a tax deduction or you get you don't pay tax on the payroll deduction that goes in your retirement account. But the deal is you pay tax later when it grows. The IRS or the tax code has this term, it's either taxed on the seed or on the harvest. With tax deferred, you're taxed on the harvest. So your 100,000 grows to 200,000. You're taxed on the 200,000. And then we have tax advantage. So in this example, we're talking about Roth. So anything Roth, whether it's a Roth IRA, Roth 401k, Roth 403b, Roth SEP now, Roth 457 plan, and I'm sure that I'm missing something, right? But anything with the tag of Roth in front of it. Now, that is money that's already been taxed, right? So you paid tax on the seed when the money went into here. And then as that money grows, you don't pay tax on any of that growth or distributions on that growth as long as you meet some of the qualifications. Really kind of simple qualifications. There's a 5-year rule. We won't get into that today, but there's a 5-year rule that says, a qualified distribution for earnings has to be held. You have to be over 59.5 and you have to have held had an IRA account, a Roth IRA account for more than 5 years. So what are we talking about? When we're talking about conversions. So there's 2 ways to get money into Roth. One of them is contributions, and the other is conversions. So today we're going to talk about conversions. Well, the tax code allows us to take a distribution from an IRA and deposit it in a Roth IRA. And all we have to do is pay tax on that. So figuring out how much we're going to convert every year is kind of the art and the science behind how we move funds, but we're just going to use the numbers we have in front of us to talk about this break-even and opportunity cost. So let's say, for example, you've got $100,000 in your IRA that you want to move to Roth, and that could be all of your IRA or it could be a portion of your IRA. But this year in 2024, you have $100,000 that you want to convert from your traditional IRA to a Roth IRA. Well, we know that rules allow that. There's no limitations on how much you can convert. You can convert as little or as much as you like. And if you had a gajillion dollars in that traditional IRA, you could, in fact, convert it to a Roth IRA, pay the tax, and that would be done. If you have a gajillion dollars in your IRA, please contact me immediately so we can review that. But you can also do as little as you want. You can convert $1,000 or $100. So there's a lot of room there, and really no speed limits, as I always say, with Roth conversions. The question is, how much tax do you pay, right? So that's really the question during that conversion. So for this example, let's say that you're going to convert this entire $100,000 in 2024, and we know, for example, that your tax rate is 20%. So there's two different ways that you can pay that tax. You can withhold that 20% and have that $20,000, right? That's $20,000 in tax. 20% is $20,000. That's going to go to the IRS for that conversion. So you can either withhold those funds, so that $20,000 goes to the IRS, never to be seen again. And then $80,000, let me clean this up. $80,000 ends up in the Roth IRA. So that's method number one for paying that tax, because you had to pay the tax on the Roth conversion. Now, here's where people say, well, geez, I had $100,000. Now I only have $80,000. So now I got to make up that $20,000 to reach my break-even point. But do you really have to make up that $20,000? Well, let's look at it. If your $100,000, let's come back here. If your $100,000 grows at 7%, for 10.2 years. I say that because that's the rule of 72. If your money grows at 7% in 10.2 years, that money will double. Now you've got $200,000, and you say, well, geez, Mark. See, if I would have moved that, I certainly would have had less in my Roth IRA. And that's true, actually, right? So because if you take the same number and you take the $80,000 and you grow that by 7% for that same period of time, 10.2 years, you're doubling it. You have $160,000. Well, $200,000 is less than, $160,000 is less than $200,000. So I'm kind of proving it out, right? Now I haven't achieved my break even. But for there to truly be a break even, I'm doing air quotes if you're just listening, that has to assume that tax is never paid on the $200,000. Because if you just pay the same tax rate, now you want to take that money out, that $200,000. You're going to take it out and spend it, buy a boat, do whatever you're going to do in retirement. Well, you're going to have to pay tax on it. Let's assume, right? So this is you. You're going to spend or distribute for some reason. You're going to spend that $200,000. Now you're still at the same 20% tax rate in this example. What is $200,000 times 20%? Well, that's $40,000. So your spendable amount of money on that $200,000 is in fact $160,000. You've already paid the tax on the conversion at $80,000, had that growth of 7% over 10.2 years in that example. You doubled your money, and then you end up with $160,000 of spendable money because it's after tax in your Roth. Because anything that you take out of here, you don't pay tax on as long as it's qualified distribution. Anything that you take out of this bucket to spend, well, that you have to pay tax on it. So if the tax is the same and you take that full amount out, then you've got to pay tax, and that tax is $40,000, and you end up with the same net amount, $160,000 here, $160,000 here. It's the same amount of money. I hope that makes sense. So then the only variable is the future of tax rates. Because if taxes go up just 1%, and now instead of $20,000, right? So your net here is $160,000 at 20%. Instead of that, what if it just goes up 1%? Now we're at $200,000 times 0.21 or 21%. So we end up with $42,000 in tax, $42,000 in tax, and $158,000 of spendable money. So in this case, it's not the same. You have more spendable money in your Roth than you would in your traditional IRA. Therefore, there really is no break even. The only way that break even really exists is assuming that you never pay tax out of that bucket, that traditional IRA bucket. And there's very, very few ways to do that. And if there is a way, if you know, for example, that you're going to send this $200,000 to charity, then you shouldn't pay. You shouldn't do a Roth conversion. But if you're going to spend it yourself, or if you're going to pass it to your heirs for them to use, the only variable is the future of tax rates. So if you think taxes are going to be at least 1% higher, you gain ground by putting it into the Roth. If you think they're going to be lower, then it probably doesn't make sense to do a Roth conversion. If you think they're going to be the same, you might want to do it anyway because you're eliminating the risk of future taxes. So the variables being, you got the same amount of growth, you got the same amount of dollars, you got the same amount of tax. The tax has to be paid at some point. Do you pay it now when you know what tax rates are, or do you wait and pay it later when we don't know what tax rates are going to be? But experts, including the folks I have the good fortune to work with, project that your average middle class American is going to be in the 40 to 50% effective tax rate in the future. And that, of course, is greater than where we are today. So I hope that makes sense from a break even. And I hope you see, well, that's kind of simple when you look at it, because the only reason that break even really exists, I know I'm repeating myself, but I want to, is if this money that comes out of the tax deferred bucket is in fact never taxed. Once you pay tax on it, once you have to pay tax, the only variable is the future of tax rates. If you think that taxes are going up, you may want to consider a Roth conversion. If you think taxes are going to go down in the future, well, you may want to stay right where you are. Now, what about this opportunity cost? Well, what about that $20,000? I understand the withholding, but what if we paid $20,000 out of this taxable bucket? So what if the whole $100,000 got converted over to here? But geez, I could have used this money and instead of sending this to the IRS, never to be seen again, I could have used that money and it could have grown. Well, you could have, and it's really the same math. So if you would have used this money, if it would have grown, and it would have grown the same amount, 7% over 10.2 years, and now it would have grown to $40,000, and then you would have wanted to use this money, the $20,000, either as a lump sum or even over time, you would need $40,000 to pay the tax on that distribution of the $200,000 at some point in the future, in this case, 10 years later. So it really is the same math. It's the same variable on the opportunity cost. In fact, it's a little more, there's more to it, because you'd have capital gains tax here. So not only ordinary income tax here, but if truly you doubled this money, you're going to have, depending on your income, you're probably going to have a capital gains tax that would make this even less attractive to wait and have that growth within those funds. So that opportunity cost argument is really out the window too if you ever have to eventually pay tax. And there are only few instances where IRAs can be distributed without tax, and they're really charitable contributions. Or if you have a standard deduction that offsets that distribution. So I hope that clears that up. There are other so really there is no break-even point. It all has to do with the future of tax rates. There really is no opportunity cost. It all has to do with the future of tax rates. There are plenty of other considerations when you're talking about Roth conversions. Your effective tax rate, your IRMA charges if you're nearing 65 or over 65. Your cash flow. There's several other considerations, but I hope that puts that question to rest for at least a little while. We may come back to it in a couple of years, and I wanted to share this video just to make sure that we have clarity on that. But I also wanted to create the video so I could send it to folks who have that question, because again, we see it all the time. So I hope that was helpful. That is the webinar for today. We're a little early today, so that's good. I'm sitting here watching my watch. I don't see any questions. It was great seeing you all. I look forward to seeing you next week. If you have questions for me, if you want to schedule time, that 15-minute strategy or discovery call, if you're not a client of ours, you can reach out to us at questions@attleborowealth.com. There's also the link in the description. Otherwise, I look forward to seeing you next week and discussing new topics. Take care. Have a great week.